Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. The oil industry is making record profits, and the amount of money that they're bringing in is grabbing the attention of political leaders around the world, some of whom, even from the White House, are calling for a windfall tax. Now, I don't think that kind of tax is likely, but these profits could continue. So I want to get into why oil stocks are making so much money today and why those profits will continue potentially for the next decade. Now let's put the amount of money oil companies are making into perspective. So this is a table that shows the operating cash flow, capital expenditures, and then reported free cash flow for the first 3 quarters of 2022 for some of the biggest oil companies in the world: ExxonMobil, Shell, Total Energies, and Chevron. You can see here that they are making record operating cash flow. This is just, remember, this is just for 3 quarters. So ExxonMobil reported $59.2 billion in operating cash flow, almost $50 billion in free cash flow. And really the numbers are similar across all 4 of these companies. But what I want you to do is compare the number on the right, the free cash flow number, to the amount that they're spending on capital expenditures. You'll see that capital expenditures are far lower than free cash flow. Typically, these companies would pour a lot of the money they're making in free cash flow into developing new oil fields or new reserves, and that's simply not happening today. This is one reason that the free cash flow number is so high compared to the operating cash flow number. They're just not putting money back into the ground that they typically have. Capital expenditures have been cut over the last few years, and there are a number of reasons for that. One is the rise in electric vehicles. So they see the end of the cash flow coming as fewer and fewer people are driving gasoline-powered vehicles. But really, the biggest reason that companies aren't putting money into the ground is that future prices are not what you might expect. Now, if you're an oil executive trying to decide if you're going to drill for oil that may not be produced for a year, 3 years, 5 years, you're not looking at the spot price of oil that's quoted on websites like Bloomberg or MarketWatch. What you're looking at is what the futures price of oil is. So what is the price of oil going to be when I'm actually producing oil from the well that I may start drilling today? And that's where these numbers get really interesting. You can see here that the December futures contract, which is the closest futures contract that's traded in large volume, is $86.14. So that's typically what we call the spot market price for oil. But if you go out to December 2023, you're looking at $76.37. Out to December 2025, you're down to $68.50. So the futures market is in what's called backwardation. And that simply means that the future price of oil is lower than the price of oil today. Now, there are a few reasons for this. One is that production continues to rise. You can see here from this chart that drilling does continue to increase. It's not back to where it was before the pandemic, but it is still slowly and steadily increasing. Companies are also getting more efficient with their drilling. This isn't like the days of early shale when production would drop off dramatically over a year and companies really didn't make a lot of money off of what they drilled. Companies are getting a lot better, more efficient with the wells. So we're potentially seeing an increased supply come into the market. And then there's questions about demand as well. The sale of electric vehicles continues to rise as a market share in the passenger market. So over time, that will eat into demand for oil. This is one reason that oil companies are probably a little bit reticent to put too much money in oil exploration, because they know that people are just going to be driving more electric vehicles in the future, and that puts a cap on their long-term growth potential. At the end of the day, it's not all that attractive to invest in the future when the future doesn't look particularly bright for oil companies. But that doesn't mean that these are bad investments, because what are these companies doing with the cash that they have? Well, they're paying down debt, they're paying dividends to shareholders, and they're buying back stock. And they're doing all 3 right now. You can see from this chart with ExxonMobil, the company's debt position looks a lot better today than it did over any time in the last few years, and it'll likely get better and better as these cash flows continue. Now, these may not be growth companies in the future, but there is a playbook here for what these might look like as investments, and that's the cigarette business. Altria, it was a company that was under pressure in the 1990s, going back almost 30 years, when smoking simply became less popular because of the lawsuits against the industry. That really capped growth. But you can see here that Altria was one of the best investments available to investors over the past few decades. Even if you bought shares in 2000 or 2010, you outperformed the market by a wide margin with a company like Altria, even though you may not think the cigarette business is all that good of a business. Now, I think this is going to be pretty similar to the oil business. This may not be a growth market over the next decade, 2 decades, 3 decades, but it is probably going to be a cash flow business. And companies are going to put that money into buying back shares or paying dividends rather than investing in their own business and growing organically. That can actually be great for shareholders because it means that cash is going back into our pockets. Next time you hear about the oil market's windfall profits, keep in mind that there's a reason that they're making as much money as they are. The futures market tells us that oil demand may not be as high as it is today in the future as supply increases. That's what executives are looking at. Maybe it should be something that politicians look at too when they think about these windfall profits with oil companies. What do you think about oil stacks? Is this the kind of business that you want to invest in to just cash flow that dividend and get share buybacks? I think this is a much more attractive business today than it was just a few years ago because of the cash flow that we're seeing. Leave your thoughts and comments below. Give this video a like, and of course, follow the Rive Project for more great investing coverage. I'll see you here next time.